How do you decide when to hold forever and when to sell?
Investors are closely watching which stocks Warren Buffett adds to his portfolio. However, you should be aware that it is just as important to sell stocks in time as it is to buy them. The legendary investor identifies just 3 reasons why it's time to say goodbye to stocks.
It's not our natural inclination to sell. And on the other hand, we have held the Washington Post stock since 1973. I've never sold a share of Berkshire, having bought the first shares in 1962. We've held Coke stock since 1988. We've held Gillette stock since 1989. Held American Express stock since 1991. We had actually previously been in American Express in the 60s in Disney. So there are companies we're familiar with. We generally sell. We would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. Would reluctantly sell something that I thought was terribly cheap to buy something that was even cheaper. Those were the times when I had more ideas than money. Now I've got more money than ideas, and that's a different equation.
For instance, in 2015, Buffett cut his Goldman Sachs and Walmart positions to free up funds to buy Precision Castbox company for $37 billion. According to the Oracle of Omaha, buying an entire company is a more compelling idea than buying stakes. Logically, most investors don't plan to buy entire companies. Nevertheless, sometimes it makes sense to rebalance a portfolio.
So now we sell really when we think that when we're reevaluating the economic characteristics of the business. In other words, if you don't want to name names, but take a stock we've sold of some sort. We probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean we think that the company is going into some disastrous period or anything remotely like that. We think McDonald's has a fine future, we think Disney has a fine future, and there are others. But we probably don't think that their competitive advantage is as strong as we thought it was when we initially made the decision. That may mean that we were wrong when we made the decision originally. It may mean that we're wrong now, and that their strengths are every bit as what they were before. But for one reason or another, we think that the strengths may have been eroded to some degree.
For a long time, Berkshire was one of the largest holders of ExxonMobil shares. During the period of investment, oil prices were high, and Buffett was optimistic about the prospects of the black gold market. However, Berkshire later closed the position as the fuel market changed and the legendary investor's optimism waned.
The classic case on that would be the newspaper industry generally, for example. I mean, in 1970, Charlie and I were looking at the newspaper business. We felt it was about as impregnable a franchise as could be found. We still think it's quite a business, but we do not think the franchise in 2002 is the same as it was in 1970. We do not think the franchise of a network television station in 2002 is the same as it was in 1965. And those beliefs change quite gradually, and who knows whether they're precise, whether they're right even. But that is the reason in general that we sell now. If we got into some terribly cheap market, we might sell some things that we thought were cheap to buy something even cheaper after we'd bought lots and lots of equities. But that's not the occasion right now.
If you bought a stock based on a positive opinion about the company, but the situation has changed, it is better to admit the mistake, close the position, and look more promising investments. In the 1980s, Buffett bought a large stake in a Freddie Mac mortgage company, and the legendary investor did not blunder. This investment grew 12 times. However, in the late 1990s, Buffett discovered a problem. Top management began to expose the company to excessive risk. As a result, the position in Freddie Mac was sold. The Oracle of Omaha turned out to be right. The company later became one of the culprits of the 2008 mortgage crisis, and its shares were basically devalued. Conclusion: if a company starts to deviate from its usual business model and its top management is too focused on short-term results, it might be the time to sell the stocks.
Charlie?
Nothing to add.
He's been practicing for weeks.
If you found it helpful, put a like, subscribe, and watch our other videos.